All right, so I tried to find the default study from Moody's. It's like everything they do now. It costs money. You have to be signed in and all that kind of stuff. I did find one from S&P. It didn't come from their site, so someone probably got it and put it out on the internet for free. I'll try to remember to put this out on Blackboard, but it's 130 pages, which sounds like a lot, but a lot of graphs. They look at default rates. You can see default rates were down in 2021. Investment grade is essentially zero, speculative, all over the place. You can definitely see the .com, the S&L crisis, the .com, the 2008 crisis, and then the 2020. You can definitely see those. I don't see it as much, but even 2008 was a fairly unusual period of time for investment grade, and their spreads especially. They show you how many defaults per year. They give you that kind of information. Just table after table after table. Here they show it by industry overall versus this last year. Obviously, energy didn't have a huge one this last year because oil prices were up. This one's pretty interesting. This shows you the default rates this last year versus the average over time. So last year was a fairly, 2 years ago, 2021, 2022 probably was a little bit rougher year given what was going on with rates, but 2021 was a fairly innocuous year. Upgrades versus downgrades. 2021 was a fairly unusual year where there were a whole lot of upgrades and very few downgrades. 2021. So we'll see if 2022 is the same way. You'll notice, what do you notice about 2008, 2009? You definitely see, but the question is it predictive? So the 2007 give you an indication something bad was about to happen. It doesn't look like it, does it? It doesn't look like suddenly they're downgrading. So it doesn't look like rating changes as any kind of indicator, but you can certainly take the data. They give you this chart where they'll do the upgrades divided by the downgrades, and they'll give you, or the downgrades divided by the upgrades, something along those lines. And you can look at that over time. They have that data. They have defaults by rating category, obviously double A's, triple A's, double A's. There was one in 1999. This 0.27, there was, so the question is, were they double A when they went under? So I don't know exactly to define this, because Enron's a good example of double A that went insolvent, but it wasn't double A when it went officially default. So they can somewhat cheat on these numbers. Triple C's, you're almost always going to see some defaults with them almost every year. But a very, very low year. That's actually one of the lowest years out there. There's very few that are 10% or below. The transition matrix are no, actually the min max of all those years. You can see it's pretty unusual for double A's, the default. But this is within 1 year though. But triple C's, half of them can default in a year, are zero. It's interesting. Single B has never had a year without at least a small default. So a lot of data. So if I were interviewing for a fixed income job, credit job, I would just read through this report and just see what kind of things they do. One thing to note that's real important is they look at things by issuer versus by amount, which can have a huge difference, because if one large company goes under, or like Argentina goes under, that's going to make it spike, but the number of issuers might not spike. So those two can be very, very different. And they show it US. Now it looks like Europe is not all that risky, but Europe doesn't have the bond market the US has. And so it's probably more just supply and demand. There's just not much of it. Table after table. So you're not reading all that much, but I would actually read the language as well. But anyway, I'll try to remember to put that out there for y'all, because there could be some stuff. But you can find it yourself. You just type default study, Moody's default study, everything that came up within the last 5-6 years. You have the register, sign in, so you can get it. The S&P, I've had trouble getting S&P in the past, but this time I got it, but it wasn't from S&P site. It makes sense. They would charge money for their own research. They wouldn't give away for free, but Moody's used to give their studies away for free. And so, yeah, it's frustrating that they won't do that. On credit, I did bring in the spreads. So AAA spreads right now are 20 basis points versus 30 historically. The max or the high end is 55, but again, you go back to 2008, which is, let's see if we can find the max here. Yeah, so 2008, the spreads on AAA look like a spread on a triple B. So what does that mean? You should have been buying these bonds in the last part of the year of 2008. I remember someone on our pension plan. Remember, I want to sell that swap and buy triple B bonds. And one of the arguments they made was, well, it's an illiquid market. So yeah, it's an illiquid market for sellers. That's what you want, isn't it? If you're a buyer, you want a market where people are desperately selling. So yeah, illiquidity is great. People can't sell their bonds because they're desperate, and you are there. And so if you go look at Oak Tree Capital, they buy distressed debt. They were buying $100-200 million a week back then, and it made them a fortune the next year. But their argument was, no, it's an illiquid market. We should be buying bonds. No, this is when you should be buying bonds. It's the best time. Here you have AA, got amazingly high spreads. Single A, amazingly high spreads. Triple B. So single A, well, actually even double A, they had high yield top of yield. I mean, look at this. Double A's yields, 439, were higher in 2008 than high yield yields are today. That's how bad 2008 was. And in high yield, it's a stock, 18%. That's the spread over treasuries, 18% spread over treasuries, just ridiculous. So 2008 was a fairly unusual year. That's why I think I mentioned, I did the analysis, and these numbers dwarf even, well, not dwarf, were exceeded what we saw in the Great Depression. So the bond market really blew up in 2008. We think of it as a stock event, don't we? But the stock guys, we were like, yeah, 35%, 40%, big deal. That's a bad stock market. The bond guys, they were walking around like zombies. I would tell people, if you see John in the hall, give him a hug, because the poor guy, I mean, it was a horrible year. He had an investment in the Iceland banks. What happened when the Iceland banks went under? People was like, well, what's the government going to do? And the government says, the banks are bigger than our entire country. What are we going to do? Good luck. You're on your own. We're not bailing anybody out. We don't have enough money to bail them out. So yeah, it was a horrible year. But then you look at the men in 2021. Remember how good 2021 was. Look at these spread. Look at the spread on high yield in 2021. Would you buy a junk bond that's paying you 268 over treasuries? Remember, their default rate is what, 15%? I mean, you're going to lose a lot. You're not going to nearly make enough return. So yields have come back up, but we're definitely not back in the danger zone. So the bond market is not telling us we're in a serious, and this is February, so we don't have a Silicon Valley in there. So I'll bring March in. We'll see how much Silicon Valley impacted that, especially with the banks on the bank side. That would be interesting. They probably have gapped out some. And you notice it a little bit because I've noticed it sometimes when treasuries are up, but my bond portfolio is down. That means treasury yields fell less than spreads gapped out. So yeah, March, you probably saw some spread gapping. But so y'all should know these numbers when you go into interviews. It's really helpful, especially to know the average. Triple B, 151 basis points where they default about 5% of the time over 10 years. You're getting 3 times the expected default rate in the spread, and that ignores the recovery rate. So you're still getting a pretty good recovery there. All right. So let's talk accountants. We have accounting majors in here, like double majors. All right. I started off in accounting because a French horn player told me, don't be an accountant, it's too hard. So I became an accountant. That was I sat down for 4 seconds and said, I'm going to be an accountant. It was between accounting or computer science because I had taken a computer science class in high school. So that was my choice. So my career counseling. I started my career for 2.5 years in accounting. and then moved to finance. Again, complete on a whim. Some guy walked by my office, my desk, and I said something to him, and the next 2 weeks later, I was working in a new department. I'm glad I made the switch, but accountants are important. They do important stuff, but they have to prepare the books. When you do something in finance, you got to make sure you don't mess them up. And you can mess them up pretty badly because of the complexity. And we talked some about this last time with, available for sale, held to maturity, permanent impairment, the different levels, level 1, 2, and 3. It gets really, really, really tricky. So you want to do something, but you can't do it because the accounting is, the reporting, the compliance is just far, far, far too complicated. I remember the first derivative I did, my boss walked over with 2 thick books and put them on my desk and said, read this. I was like, I'm not going to read that. But that's what he said. You got to go through. Have y'all seen the rules on FAS 133? Another good FASB for you to read. I don't know why I keep clicking on that because nothing I see. I'd love to show y'all stuff, but we don't have computers at UTSA. Yeah, still nothing. Dick Van Dyke, that's probably not going to be relevant. FAS 133. How complicated can accounting for derivatives get, do you think? How many pages is this thing? 176 pages. My guess is y'all didn't see this in your classes either, right? What do accounting classes do? They do widgets. You got raw materials, stuff that no one in the US does anymore. That's what you do. You spend a lot of time on FIFO and FIFO unlocking, something you'll never see in your entire career, if you work for a bank especially. So the key is it a hedge or not a hedge? If it's a hedge, was it a cash hedge or is it a price hedge? And the rules are all radically different depending on which those are. Really complicated stuff. For our derivative, designated as a hedging to the exposure to variable cash flows of a forecasted transaction, referred to as a cash flow hedge. The effective portion of the derivative's gain or loss is initially reported as a component of other comprehensive income outside earnings and subsequently reclassified into earnings when the forecasted transaction affects earnings. The ineffective portion of the gain or loss is reported in earnings immediately. So on the final exam, you're going to have to explain that to me. I'm going to put that on exam. How many of y'all want to do that? Could you tell someone what I just read? That's just one paragraph. What about derivatives designated hedging of the foreign currency of a net investment in a foreign operation? The gain or loss is reported in other comprehensive income as part of the cumulative translation adjustment. Have y'all seen accounting for currencies? We're going to talk about that when we do currencies. It's so complicated, so ridiculously complicated. So you tell your boss, hey, I want to do some options. I think it'd be really, really good for hedging our risk. You've got to figure all of this out. It's incredibly frustrating. So the way, well, we'll talk about it in the mitigation. So the way I handled it was I went to the accountants very, very early in the process. I made sure they're at the front end. What you don't want to do is you recommend something, you're in front of the exec council, and they turn and look at the CFO and she says, I had no idea y'all were doing this. We'd have to look into, that's the worst. You want them to say, yes, we've looked at it, we've reviewed it, and here's our recommendation. So you got to get into it. How do you measure it? It's just, if the FASB is 170 something pages, when your index looks like that, you're in trouble, right? There's an appendix F at page 540. I only have 176 pages, so this thing stops somewhere around here. I don't know where the rest of it is. And it's not like the S&P one, is it? There's no pretty pictures in here. This is just if you want to do a few options and features. This is the rules. So it's a pain, real pain. Oh my word. Just thick text. So I didn't read any of this. I just go to the accountants and say, this is what I want to do. And you guys research it and you let me know, but I make sure they know early on what we're thinking about doing. So just really, really tough stuff. So get to the accountants early, get the legal early, be really nice to those people. They can make your life miserable. You've really got to get them on board. Their reviews take a lot much longer because it's not like they're just sitting there waiting for you. They got their regular job to do, so they got to research it. You're going to hire people and just have to read through all these scenarios. You can hire lobbyists to try to change the rules if you'd like. That's not going to be all that effective. So there are times where you have a great idea. It really would be great, and it's the disclosure requirements that are going to mess you up. So Dodd-Frank, this is something out of The Economist when Dodd-Frank came out 10 years ago. So you think of Dodd-Frank as being a law, but Dodd-Frank was a law, but it was also a data gatherer. And so what Dodd-Frank said is, here's the principles. Now Dodd-Frank was, I forget how many pages. Does it tell you how many pages in here somewhere? Dodd-Frank, 848 pages long. It's 848 pages, but that's nothing you're going to see in this Economist. That's not even a fraction of what's going on here. So, but I do recommend, there is a book I recommend related to this. I think I've shown y'all this before. So I'll show it to you again. Get this. I think it's the very last one on the list. No, this one right here. Has anyone tried it yet? I do. It sounds so boring, doesn't it? Regulating Wall Street, the Dodd-Frank Act, and the new architecture of global finance. I found it really a good read. Really, and I listened to them on my book. I'm on my bike, so it's the book I just read, The Seven Powers. It was a good book, but he had all these long formulas. It's hard to listen to formulas when he's saying big parentheses, small parentheses, SP minus SJ4. You know, you can't listen to that. But this book worked really, really well. I found it really fascinating. If I were interviewing with the bank, I would definitely be reading this book, or interviewing with any risk management department. Now, it's interesting. Their book is shorter than the Dodd-Frank bill. So it's like 400 or 500 pages, and the bill is 800 and something pages. But they don't just talk about the bill. What they talk about is what the bill says, will it be effective, and is there a better answer? So I like is there a better answer? And they asked the question, if Dodd-Frank had been in place in 2007, would 2008 have still happened? And their answer is yes, it still would have. Dodd-Frank would not have prevented 2008. And they also say, here's what would have prevented 2008. Here we can show this early warning system that they actually have on their website. If we had had this in place in 2007, it would have told us things were going wrong in 2008. So it's a really good book. It's written by a bunch of New York Stern School of Business professors, 5 of them. Very well written. I don't know how 5 professors write a book that's that well coordinated, but it was a very, very good book. So it's going to cost a lot of money. It's going to have problems with it, inconsistencies. The American Banking System Act was 29 pages. The Federal Reserve Act was 32 pages. The Banking Act that, the Glass-Steagall Act, that was 37 pages. Why are laws today so long? My health insurance class, we talked about the Affordable Care Act. That thing was, I think, over 1,000 pages. Why are the law? Who's writing these laws? Have you ever thought about that? We're a democracy. Do you think a congressman or congresswoman wrote the 848 pages of Dodd-Frank? How many words in Dodd-Frank do you think an elected official actually wrote? Would you guess 0? I would guess 0. So who wrote these? Their staff? Their staff didn't write these. Who wrote this? They hire consultants that write this stuff. And why is it 848 pages? Because there's a lot of copying and pasting from other laws of stuff they just have to put in there. How long did Congress review this before they passed it? This is our democracy, is passing these rules. The people writing these are very smart people. People like the person from New York Stern. That's the kind of people they hire. So they're not hiring a bunch of lobbyists. They have a bias. They're hiring people that are knowledgeable in this. But when it gets to the point of Congress after actually passing these laws, it's how much of the detail do they really know? So Dodd-Frank is not directed at people, is an outline directed at bureaucrats and instructs them to make more regulations and create more bureaucracies. It includes 383 explicit questions for firms, which if read closely break down to 1,420 sub-questions. So there's a lady at USAA, I thought really impressive. I always liked working with her. I thought, wow, she's going to be a senior vice president. But she decided, no, I don't want those responsibilities. So last time I saw her full-time job was the Dodd-Frank Act. I was thinking, what a waste. This is a really smart person, really valuable to the firm, and her entire job now is Dodd-Frank. It's like, and how well have they done? She doesn't work anymore, so you can't blame her. But USA is really messed up, haven't they? So, you hire people to do nothing but these regs, and they still have huge problems. It mandates 87 studies. How much money do these studies cost? I remember on Social Security, they spent hundreds of thousands of dollars on a study. I thought it was a really good study. That was very impressive. They gave it to Congress. Congress said, thank you very much, shredded it, and went on to the next study. Didn't do anything with it, didn't debate it and discuss it. So who does stuff with the study? Have you ever thought about a federal government that has thousands of banks submitting 1,420 sub-questions? And what did they do next? What did they do with that? Is that the job you want? Collecting all these questions? What are you going to do? Are they coming in electronically? How do you know when you need to do something? If someone answers a question that's not good, someone has a hand on all of this. And what is their skill? If they're a bank regulator, they're being paid what, $67,000 a year. They're not, they're not the top people in finance, or to be working for Bankers Trust or for not for Bankers Trust, for Goldman Sachs. So it mandates 87 studies, but that no one is scrutinizing them. So we're reporting all these things. This typical government. I remember at USAA, they went to electronic filing of financials, and we said that's fine. What are you going to do with it? Say no, we had to send it in on a drive. So we sent it in on a drive. So that's interesting. So they must be doing something. So a friend of mine went to this Capitol, went to the insurance council or whatever, and he found those drives. There was a big barrel full of these drives that they just threw away. They didn't do anything with them. But the law mandated. Someone said, hey, wouldn't it be good if you did this electronically? It makes sense, but no. So that's the kind of laws that get passed. No one really thinks through that someone is going to have to process all of these questions. It would smother financial institutions with so much red tape that innovation is stifled. So that's the other issue: is does this make us safer? Or does it just make banking more expensive in the United States? More intrusive regulatory, the lack of clarity, which follows from the sheer complexity. Now, who are these regulators? So I dealt with the regulators. My career, I started with insurance regulators, real nice people who didn't really care much about regulating. They spent most of the time reading a newspaper in the morning. It's kind of, it was like this decently paid, really cushy job where there was no stress, and you just came in and read the paper for 6 hours, and then at the end of the day, you do something. One regulator was mad at us because we had our investments in street name. He wanted to see the certificates for our bonds, and we say we don't have certificates for our bonds. They're in street name at our custodian, and he wanted to write off $10 billion of our assets because we didn't have the actual physical securities. We called our custodial bank and they said, well, good luck finding any. No one, we might have 3 here. We don't do physical securities anymore. But that was the regulator. And so I said, well, surely the bank regulators are better. So I met the bank regulators. I told them what we did, and they were like, wow, that's so cool. Wow, I never heard of that before. Things like capital asset pricing model, efficient frontier, they never heard of that. So then it's the SEC regulators. All right, they're the best, same thing. But that's what you expect, right? Regulators get paid much less. If regulators are going to do their job, we're going to have to start paying them $500,000, $600,000. It's not that they're bad people. It's just that these are people who, man, this is the job they got because they couldn't work for Goldman. Goldman doesn't hire people for $60,000. They hire them much higher. So it's and government has had this debate. You've seen this on the investment side. Sometimes the highest paid people in government are the investors, the people running the funds, and people complain about that. Why should some government person be making $200,000? But that person could make 300, 400,000 in industry. So government has an issue. If they're going to regulate us, they got to be at least as smart as the people at Goldman Sachs that are trying to do what? Get around the regulation. And they got what, an MIT degree and PhD. So it's almost impossible for the government. And can they get around that by making it 848 pages? I don't know if that's the solution either. So it encourages, when you make it so complicated, you just encourage gaming. You don't hire people at Goldman to see if we can meet the letter of this law and the spirit of this law. You say, how can we hire people so we can keep doing what we've always wanted to do, but we check the box on Dodd-Frank. The overall cost is staggering. So what is Dodd-Frank trying to do? Risk-based capital requirements, try to get banks better capitalized. That seems to have happened. Leverage limits, short-term debt limits, liquidity requirements. They seem like they failed on that kind of royally. If you look at what happened with Silicon Bank. Resolution plan and credit exposure requirements. Sounds like they focused that mainly on the big banks. And Silicon Valley was what? Slightly below the big banks. If a big bank's 500 billion, a $300 billion bank, they're okay. Let's not worry about them. Concentration limits, that wasn't really a Silicon Valley issue. Contingent capital requirement. I don't know if Silicon Valley had that. Public disclosures. Did it address too big to fail? So that's the issue. Too big to fail today. We're talking about $2 trillion entities. So y'all wrote about that, and y'all weren't real committal in your paper whether these firms are too. How many of y'all said your bank was too big and needed to be cut back? Isn't that what Elizabeth Warren was saying? Or is that more? I guess Google, and does Elizabeth Warren say break up the banks? She may have said that. Could you break up JP Morgan? And how would you break it up? It's a pretty big bank. I worry about it. I mean, it's $3 trillion banks. Can you really let JP Morgan go under? But $3 trillion is a lot of money. So it would be interesting. Be ready. Now, fortunately for me, the first derivative I did was the interest rate swap, and we did it in our pension plan. I had two big advantages there. First of all, pension plans are already fair value accounting on everything. Assets and liabilities, everything's mark to market, so I didn't care. That was already there. I didn't worry about the hedging, accounting, all that kind of stuff. The second thing is they had just hired a new accountant that knew all about FAS 133. I was like, whew. So I just went to his office. We met for like 30 minutes. He said, don't worry, everything's fine. I said, fine. You're going to sign off on everything. So that saved me. If he had not been there, I would have been in a lot of trouble. So I was just very, very lucky. But in a pension plan, I'm going to talk about, when we talk about tax risk, outside of the pension plan, it got a lot more difficult doing derivatives. So if you want to do derivatives, I just tell you, don't say, oh, I'm going to start doing options. No, there's an army of people you're going to have to talk to and go through all the scenarios and figure it out, because it gets pretty tough. So be nice to your accounting peers. I wasn't nice to them just to butter them up. They're nice people, they're my peers, but I was glad that I hadn't been nice to them. Same thing with the CEO's secretary. I was always so nice to her because she was real friendly. And I was so glad I was, because I could get on her calendar anytime. And I remember one guy, I was sitting there, the CFO secretary. I was sitting there waiting to meet with the CFO, and she slammed the phone. Some guy was so rude to her, and she said, yeah, good luck him meeting with this in the next 3 weeks. I go, yeah, that's a stupid person. You should be nice to them because they're nice people, right? But at the same time, secretaries are very powerful people. And so I was so glad. I'm so glad I've been nice to this person. All right, tax risk. You have to worry about the tax side, tax implications of your hedging transactions, because the IRS does some really weird things. So what is the risk here? You have some kind of investment or hedging idea that looks really, really good before tax and completely falls apart after tax. And there's three ways that can happen: timing, character, and source. The timing risk is probably the worst one because the IRS likes to move gains forward and likes to defer losses. And they do that a lot. And they do it a lot mainly because people have gamed the system in the past. And the IRS solution is the way we'll stop people gaming is we'll just harm everybody. People that do things legitimately and the people that were gaming the system, they're both going to get destroyed. And that's the way they do it. So if you hedge something, the gain part of that transaction might get taxed immediately, but the loss, the other side, you may not be able to take the tax write-off on that. So that can cause a huge issue. And you might say, well, I can create the loss. I'll just sell what had the loss. I'll get the tax loss, and then I can show that on the other side. I'll talk about that here in a second. The character of the gain, was it normal income or was it a capital gain? That can be huge as well, or short term versus long term. That's not as material now as it used to be, but it can still be material. And the sourcing. Is it US or is it non-US? And that can be a big issue. So let me talk on this timing. So what I had to do, so let's just think through this, because I want y'all to see how I want to warn you that life is complicated, which is good, right? That's why they pay you so much money. So this is good news. This is really complicated stuff. Right. So I thought, oh, this is a piece of cake. I have a stock portfolio. And I want to hedge it with options. That sounds pretty good. All right, so what are the scenarios? I can have a gain here, which means what am I going to have here? I'm going to have a loss. I can have a loss here. That's going to be offset by a gain. All right, so that's good. I have a gain in the stock portfolio, loss in the options, no problem. I'll just take the tax write-off on the options. Well, if the tax department says no, you must wait until you sell the stocks. Say, what? I can't take no, you can't take that tax loss until you sell the stocks. Say, well, okay, that's fine. When I sell the stocks, then I'll get the tax loss. At least I've got the accounting covered. So here I have the gain. It's taxed immediately. I say, well, wait a minute. Why can't I wait until I sell the stocks to take that gain? It's like, no, gains on options get taxed immediately. Loss on options get taxed when the thing they're hedging gets. It's like, that doesn't seem fair. I'll say, well, you know what I'll do? I'll sell this to create a loss. That'll solve it, right? Well, it says, yes, you can do that, but you can't buy it right back. So I can't sell that stock portfolio, take the loss, and then turn right around and buy it again, because that's called, y'all know what the term there is? It's in the notes. A wash sale. So if I buy the portfolio back within the next 90 days, the IRS says you didn't really sell it. So then I started getting, I'm talking to my tax. I had a really good tax. This guy was, if you're a tax, you have friends that are tax people, go to USA, their tax department, at least back then, was exceptional. This guy was really, really good. So I said, well, I know what I'll do. I'll sell, create loss, and buy a different portfolio. Well, I told him is, you know what, I got the S&P 500. The portfolio is like the S&P 500. So I'm going to sell that, and then I'm going to buy a portfolio that's skewed toward value stocks. And so that'll work. He said, yeah, as long as you're willing to be before court under oath and say that the reason you did not do this for tax reasons, but I'm doing it for tax reasons, but under oath. So he's essentially telling me, yeah, you can go to jail if you do this transaction, yeah, it was like we could not think of a scenario where we're going to come out ahead. So here was our final conclusion. I kid you not. Let's talk again in November. That was our final recommendation. Let's sit down and see where we are in November, and then we'll figure it out. And so at the end of the year, we had like, I don't know, 500 million option gains. We had 500 million unrealized losses on the stocks. So we did great, right? Our portfolio was up 1%, so we didn't worry. We perfectly hedged all of that. But if this gets taxed, 500 million gets taxed, that's $200 million, and I get no offset up there. Did I really hedge it? What happened to my earnings that year? I still had a $200 million loss after tax. But did that really happen? No. What really happened? Anybody guess what saved me? It all worked out perfectly. Can y'all guess? Nothing I did. What year is this? 2008. What saved me? What saved me was 2008. Guess what? We had so many losses everywhere else. It didn't matter. They actually were happy I had a $500 million gain because it gave them something to offset all those horrible losses too. So I actually saved them and gave them something to write off. So it actually ended up working out really well because they had so many losses. They didn't have enough taxable income. So I gave them taxable income to offset. Is that the best way to plan? My plan is I'll be lucky at the end of the year, but that was my plan. That's the best we could come up with. That's what the IRS does to you. My best plan was I was lucky at the end of the year. We really could not come up with a better solution than that. We still would have been pretty good, right? That's still, we cut most of the loss off, and we might eventually get the tax gain here, but this jumped back in 2009, so there was no loss there in 2000. There was no stock loss to offset that with. So it was just very frustrating. The guy who was in the tax department, he knew. Well, I wish I could remember his name. I don't know if he's still there or not. But he gave me about a 16-page report, and he did it exactly right. You can see how we did this. We tested the extremes. This is exactly what you got to do. Go test the extremes. And what if this happens? What if the stock portfolio is up 500 million and the options are down 500 million? What about the other? We went through every scenario and we walked through it, and he had no solution other than, are you willing to go to jail for this, kind of thing, because he had to make the decision whether they paid the tax or not. So if I tell them, no, this is a legitimate transaction, all this is fine, he was going to check with his lawyers. Obviously, he's not going to take my word for it, but it's not like I can, go and then tell the truth in the court. But then he did it exactly like I told him, right? I put him in jail. I guess that might work, but he has to make a decision now, which if the IRS 2 years later decides it was a wrong decision, we're in trouble, right? So these are tough things. We could have called the IRS and got an opinion on it, but you don't always want to do that. That kind of clues them in to. Has anyone ever gone to jail for these type of decisions? Talk to Pete Marwick and some other the big audit firms. They go to jail quite. They get in a lot of trouble for these type of tax schemes. So you can't just say, "Hey, I'll just sell it and buy something different." I really thought selling the S&P 500 and buying 50% growth, 50% value, that would be good enough. And he said, no, that's not it. And what the IRS asks is, what's the main reason you did the sell? If you generate a large loss, taxable loss, they're going to ask, what was your purpose? If your entire purpose was to generate the tax loss, they're just not going to allow it. And they're going to ask you that under oath. And they'll probably notice that type of deduction. Right. If you take a $500 deduction on your tax, they may not notice that. But you take a $500 million deduction, they're probably going to look into it and scrutinize it. So, but I was so lucky and very glad we had a great tax department. Got to him very early in the process, and no solution because there wasn't one. It wasn't like he wasn't doing his job. There really was no solution. The IRS really had our hands tied. All right. Any questions on taxes? Isn't that irritating? Don't you wish my pension plan was tax-free? I had so much fun in pension. I could do anything in there. Everything is fair value. There was no taxes. It was like just playing. It was whatever we wanted to do. And then we came to the property casualty company, and suddenly everything's messed up. So thanks to the IRS. All right, operational risks. Boy, this is like everything else. So here we're talking about procedures and policies. The policies are not followed or they're poorly designed. Here's where internal controls come in. This is things like Sarbanes-Oxley and those type of laws that require boards to actually sign off on the internal controls. You've seen this. You probably have heard this book, Rogue Trader Design. See if I can find this book. Not the movie, the actual book. So have y'all seen this book? Have anybody seen the movie? It doesn't look like a very good movie to me, but maybe. And I don't know how closely. I do recommend this book though. It's a really good book. Or buy it for your accounting auditor friend because the auditors really messed up in this particular case. Have y'all heard of Nick Leeson? So he's a trader for the Queens Bank, Barings Bank. One person. Now he wrote this book. The management of Barings Bank don't agree with his book. He doesn't come across great, but he comes across better. But his argument was he was running this desk, I think in Singapore. He's running this desk and one of his traders made a mistake. And it was a few $1 million. So they decided to double down, see if they could offset the mistake with the gain, and they did. It worked out. So they said, oh, that works out. And then they happened again, and it didn't work out. And then it didn't work out. And then it didn't work out. And it kind of just started mushrooming until he was a few $100 million in the hole, which is horribly. And how do you hide a few $100 million? But he hid it. He created, I can't remember if it was Citi or Chase, but he created a fictitious bank account that he said had $300 million in it. It didn't exist, but he said he had $300 million. How hard is that for an auditor? What does an auditor do? They confirm the account, don't they? Pretty easy to do. So why didn't the auditor catch him? And that was what he thought was going to happen to him. This auditor, she had this reputation for being really, really good at her job, real stickler. She comes in his office. He's like, it's over. I'm done for her. And before he can meet with her, she gets a phone call. She gets called back to England and her understudy's there. And her understudy thinks Nick Leeson's the greatest trader to ever walk on the face of the earth. He's like, oh man, it's such an honor to meet you. He never checks anything. He keeps piling up his losses. There's one point he talks in the book, I don't know if it's true, that he was such a great trader. He was losing money, but they thought he was making money, that they want to honor him in New York City at a big banquet. And he's like, okay, the gig's up. If I go to New York, this whole thing comes unraveling. So he calls them and says, you know, I can't come to New York because I got to do my trade. So they gave him a Bloomberg terminal in his hotel room so he could keep losing money for the company. And that's the kind of thing he wrote. Now, the management says they weren't quite that clueless, but that's what he was saying in the book. It finally unraveled. The whole bank went under. He actually spent time in jail. I think he got out for a medical reason. I'm not real sure. You could probably find them. Nick Leeson, Wikipedia. And this is one Wikipedia you probably wouldn't trust. So he probably the management of Baring jumping in there and editing it. Nick Leeson's editing it. Downfall, imprisonment. He pleaded guilty to 2 counts of deceiving the bank auditors and cheating the Singapore exchange, forging documents. In 1999, let's see. He got married after all of that, so it doesn't say how he came out of jail, but I think he had some medical issues where they let him out a little early. For good behavior. 4 years and 4 months for good, I guess, for good behavior. Well, colon cancer too. So His book makes him sound like he was trying so hard to help this guy out, and it's got out of hand. And then when it got out of hand, it really got out of hand. I mean, it makes him sound like he's not such a bad guy, but who knows? It does portray management as just really, really clueless. But the real the worst person in this is the auditor. That if the auditor had just done their job, they would have lost a lot of money, but they wouldn't have gone under because the auditor would have found it in time. But that's a really good book. So you got to have good internal controls. You have to have good systems to catch those kind of things. You need to have good people in compliance. So when I was at USA, I started in the mutual fund side. This lady named Stephanie, she comes in my office with massive books. Here's your regulations. Here's your all your internal controls. It's like, I'm not reading this. But she was so good at her job. She would let me know anytime I was getting close to the fence. And so she was just really good. She was so good. Anytime we dealt with another party, she would go and review their internal controls, and they would call us afterwards and say, yeah, we're making changes to our processes because she found a lot of stuff we're not doing right. So she was really good at her job. So, and she loved her job. I thought, man, I don't know if I enjoyed this, but she knew she was good at it, and she really took it seriously. You need people like that. You got to worry about reputational risk. I'm going to talk about that more on Thursday night. Lawsuits, obviously. Operational disasters, we'll talk a little bit about those. Yeah, these are issues. On internal controls, I think I mentioned to y'all, USA let me do option trades, and it put no constraints on me whatsoever. I put my own constraints on myself, and I set it up that they knew what I was hedging and to make sure any trade I did was a hedge. So if my hedge position was 50 contracts, I shouldn't be doing 75 contracts. And so I would do that, and I actually tested the system. There's a guy named Cyrus, and one day I did a trade and he didn't publish his report. So I called him, Cyrus, what you're doing? He said, well, I was too busy. I said, no, you got to do it. Kind of jumped. I mean, this is real important. He's great. He's, watching me, not that I'm doing something wrong, but you need to do this. Is really important. One bad trade. I remember one trade I made where I was going long, and the email comes in and on my short position. It's like, oh no, my heart rate went up. I was like, what'd I do? And then an email comes out, sorry, we meant to say long, we said shorts. But these kind of things were the Nick Leeson thing, one bad trade, and what are you going to do? Do you just cut your losses? Those kind of things you have to worry about. How well is the system going to actually catch that? So how do you measure this? It's just extremely hard to measure. It's just everything that can go wrong. This is one of the ones I use myself personally, which is the close call approach. So I'm a bike rider. I ride my bike every day. Bike riding is pretty dangerous, right? I've had several crashes, but every time I have a close call, I think about it. I've changed my path of how I go because of that. There's one road I now avoid because there's 18-wheelers on it all the time. I used to make a mistake. If someone stopped at a sign and I think they were waiting for me, I'm just going to go past them. I've learned not to do that because a lot of times they don't see me. They just run right into me. So if I see a car, I go around it and come back. Certain things I do now, just 100% of the time, because I'm on a bike and they're in a several-ton car, a mistake is more painful for me than it is for them. So every single time anything goes wrong, I had a bike I bought last year that I had 3 wrecks on. And so I thought about all 3 of them. They all happened the exact same way. So I've stopped doing what that was causing the wreck. So close calls can be really good on those type of things. A lot of firms, if it's a close call, they just ignore it. But you should write it down, think about it. What could we do to prevent? Because the next time it won't be that close call. There's a story about, I don't know how true it is. You can probably find it on the internet, but the U.S. military having a lot of close calls with a I forget what it's called, but it's like a sky thing carrying people across on a cable. Close calls, but they never did anything about it. And one time, sure enough, a plane actually cut the tables and killed some people. So they had they knew there was close calls, but they didn't do anything about it. So close calls can be pretty good. Redesign policies, procedures, prevent those things from happening again. Processes, obviously the most important thing. The fact that nothing's ever happened in the past doesn't mean you don't need to watch this really, really carefully and closely. especially for these tail events that you don't want to have happen. You need to watch those really, really carefully, but very, very, very difficult to measure. You really don't know until it happens sometimes. How do you mitigate it? So operational risk are mitigated through well-constructed, tested procedures, constantly monitored. So here's how I do it. You might think this sounds weird, but I sat down and figured out, how can I destroy USAA? What could I do to bring this entire company down? Because one person shouldn't be able to do that. And I thought, what if I did this trade? That's when they had me doing, interest rate swaps and stock options. And it's like, I can do whatever I want. They let me do any trade I want. They shouldn't allow me to do that. So I figured out, how can I destroy this company? And then what procedures would keep me from being able to do that? That's the reason when Cyrus sent out the report, it's like, hey, you got to send this out. I'm sorry, you're going to have to work an extra 10 minutes of overtime, but you have to send this report out because every single trade needs to be monitored and watched closely. So that's the way I did it. Now, when I started my career, this would have been nothing. I mean, maybe I could set the building on fire. I don't think USA's building would actually burn down. I'm not sure what I could do. I could drive my car into the building. It would just slammed into those brick walls. There's not a whole lot I could have done. Even headline risk stuff. I could have done something to make the headlines. They would have just fired me and say, yeah, we didn't know he was a weird kid. But so there wasn't much, but further my career, I had this reputation. Oh, we trust Ron. Well, why do you trust me? You shouldn't, right? USA shouldn't trust anybody. That shouldn't be their approach. Oh, he's been here 20 years. He's a trustworthy guy. No, that's absolutely stupid. You don't know. I just had a horrible breakup, like the guy at Societe Generale, right? He's just mad. I'm gonna bring the whole company down. He just had a bad day. Who knows, right? You shouldn't trust people. And so that's my approach. So try that early in your career, probably be like early in my career. You're not going to think of anything. But later in your career, think about these things. We're going to talk about it a little more, especially when we're talking about CEOs and CFOs, what they can do. Top management, the board, auditors, investors, regulators, you need to remind constantly about the downside of their decisions so that they're aware of them. We're going to talk about one case where they weren't aware and they made some really stupid decisions, not being fully understanding what was going on. So it's really a communication issue. You've had this in your accounting classes, internal controls. So they're either focused on frequency or severity. So preventative controls, you're trying to keep the thing from happening. You're trying to reduce frequency. Detective controls, you're trying to reduce severity. They're both in place. Now, some controls, they're just there. There's one report I got that I was supposed to sign every month, and I had no idea what it was. It's like, what am I signing? Or like, just sign it. We just need to sign it. It's like, but what am I signing? I mean, this is a control. They say, well, you're signing it that this report is correct. Well, nothing that report had anything to do with me. So I was like, I'm not going to sign this. I don't even know what any of those numbers are. But they said, well, on page 7, that's your stuff. I said, yeah, page 7's my stuff. So I signed it, Ronald Sweet, for page 7 only. Every time I signed it, and I signed it, and they were happy, and they went back because I signed it. But it's like, I'm not going to sign for the other 12 pages because I don't even know what are on those pages. That's not my stuff. So, but that was a big control in the investment world, is have someone sign something. I signed all the trade tickets. Well, that makes sense, right? I want to make sure I did that trade. We had times where Michael would do the trade and we would sign afterwards. We trusted Michael, but could he have done something crazy? Yes. So I guess I'm violating my own rules. But it was Michael, and we were in a meeting. We couldn't do it, and I did trust. Yeah, some of y'all met Michael, right? I mean, he's a very, very trustworthy guy. So yeah, Michael, you do the trade and tell the trade desk we'll sign the trade ticket afterwards. But signing stuff when the person signing is not actually looking at what they're signing is not a good control. And then your accounting controls, you have authorization to make sure the right person is signing it, making sure you keep track, keep documents, and then someone to reconcile, and you need to make sure the person reconciling is not the person that's being graded. All that stuff you learn in your internal audit class. Got to keep things under security, make sure you separate duties, all these kind of things. Now, Glenn Holton, he has some books out there, and he's got a website. I don't know what his website is like today. It's called Risk Management. He's a professor. I don't know where he is. My favorite article of his is called Defining Risk. We read this in my staff and they all hated it. So I don't know if you'll like it. I loved it. I thought it was a great article. So it's very dated, but it's still appropriate today. But he's talking about, this is a guy who does risk management. He has a consulting firm. He does risk management. He's a professor. So you think he would be a big believer in risk management, but you read through this. I mean, he gets through Knight and Hume. I mean, he's getting really philosophical here. Markowitz, I don't know why that's even in his paper. It doesn't really belong. You probably skip that section. But it goes through all of this, and then you get to the very, very end, the conclusion. And he's asking about measuring risk. And so he says, the right question isn't, can we measure risk? Because we can't. We can only measure risks that we can conceive and observe. We can't measure risk. So he says, it is meaningless to ask if a risk metric captures risk. Instead, ask if it's useful. So he just wrote an entire paper essentially saying his job is kind of useless, that you really can't do what he's saying you're supposed to do. And he goes through all of that. But it's an interesting paper. It's kind of a rough read, I guess, but it's a good paper. Another paper he wrote, I don't think he links that paper anymore. He used to. Maybe he put it in his paper. I mean his book. See all articles. Let's see if it's there. How to calculate value at risk step by step. There you go. How to start a new risk management job. That might be useful. How to measure VAR for a pegged currency. Snappy comeback to the latest criticism of VAR. A lot of VAR stuff, right? Is risk management a job or career? That would be interesting. Fooled by black swans. Well, I need to read some of his articles. I didn't realize he had so many of them out there. Wow, really, really good. All right, so he's done some really interesting stuff. But the article I wanted to talk about is this one, Enterprise Risk Management. So he wants to ask, what is a good enterprise risk management? What does it look like? And he says it has three components. There's culture, there's procedures, and there's technology. And that's almost humorous when you read it, because he asks, why did these big things happen? Orange County, Barings Bank, Doway Bank, Sumitomo Bank. And if you add those examples up, they're smaller than what Merrill Lynch lost in one day in 2008. So they look puny today. But that's part of what he's asking is, what's different about today? Why are we seeing events like this today? And we didn't see events like this in the 70s. And what's unique about it? What's unique is one person or a few people are doing massive, massive damage, like you saw Nick Gleason. You didn't have Nick Gleasons in the 70s. You didn't have one person picking up the phone and destroying the entire company. So what's going on? And it's derivatives. So remember the interest rate swap I did. I buy it, it costs zero, it goes on the books at zero, and a few years later it's worth $500 million. If you're focused on what's on the balance sheet, there's nothing there. It's zero, and yet a few years later it could be up $500 million or down $500 million. That's a lot of leverage. I mean, that's almost infinite leverage, isn't it? From 0 to 500 million, that's infinite leverage. So you can do a lot of damage with one phone call. But that's why we love derivatives, because you can also eliminate a lot of risk with one phone call. Y'all saw that when we did dollar duration gap. It doesn't take much to manage a lot of risk. So it's not that people are worse today. It's just that we've given them far more devastating tools. And management, they don't want to admit they don't understand this. They don't want, you come in and explain something to them, they're just going to shake their heads like this because they want to, be the smartest person in the room, and they may have no clue what you're talking about. I fortunately had some pretty good management. Joe Robles was my CEO. He understood this stuff in a nanosecond. Very smart guy. I could send it. General Facilio. He'd always joke about, "Oh, Ron, you know this stuff. You're so smart." And I'd say stuff to him, and he would understand it better than I did. It's like, man, you're a really smart guy. But he wasn't a finance guy, but he understood it immediately. Just just really smart. But this isn't what they do every day. They see this once a quarter, so it's, you know, hitting with complexity. So it's tough to get them to fully understand what you're doing. They don't have the time, and a lot of times they'll approve stuff just because they don't have time to mess with it. Regulators, rate agencies, they're demanding better risk tools, but they tend to focus on what just happened, not on what is about to happen. So ultimately, in a crisis, only survival matters. So here on culture, what's a good culture? So a lot of times students, you know, you get to enter an interview and they say, what questions do you have for us? I would probably ask a risk management question at the end. So I would set up the question by letting, you know, kind of letting them think the kind of person I want them to think I am. So I say, I want to work for a really high quality company that understands value and understands risk management. So I want to work for a company, if something's going wrong, you can fix it. So what kind of risk culture does this company have? And the amazing thing is, you may be interviewing with someone who's really upset, and they're going to tell you what they think. Does anyone have an interview like that? You get someone who's just like, they hate the company and they're interviewing, and it's like, no, we don't fix stuff here, man. I've been complaining about this thing. And then some people are like that, and it's like, and you're going to hear it right from the right person. Remember my health insurance class, whom do you want to ask if you're going to need surgery? You remember that one? Whom do you talk to? You talk to the nurses, right? You want to know, if you ask a nurse, would you have surgery at this hospital? And they say no, you probably don't want to have surgery at that hospital, because they know better than anybody else. So, you know, ask these type of questions. They're great questions. It lets them show that you're serious. You want to work for a great company, and that's what great company is. Understands value, fixes problems before they become massive. So, do you have a good risk culture? What is a good culture? Well, a good culture, you don't lose your job by raising issues of problems that are going on. So you hear alarmists. It was pretty interesting in Bob Davis. If you raise an issue, he got mad really fast and he would scream at you in the meeting. And so he wasn't really encouraging, but he never fired the person he was screaming at. He fired the person who didn't tell him about the bad problems. So I remember a vice president called me once, and her question was, why hasn't Bob fired you? Because we're trying to figure out how to manage this guy, and he screams at you all the time. Says, well, he's not screaming at me. He's mad because of the thing I'm telling him about. He's not mad at me. He just doesn't know how not to scream at me when he's mad at something else. And so I just sit there and go like this, but he's really appreciative that I brought it to him. And so, and I'm like, you know, I'm independently wealthy. He can fire me. What do I care? I'll probably get a severance. So I have nothing to worry. I had no, wasn't like I was just up straight. You know, it's just, I don't really care. You can fire me. I'm just telling you that you have this major problem over here. We need to fix it. So it worked, but there was other people seeing him scream that he was like, I'm not going to bring it up to him. And those are people got fired. Once he found out there was something wrong and that someone knew about it, that person was gone, and he didn't have any patience. So was that a good risk culture or a bad risk culture? I don't really know. And his screaming at me didn't help his case very much, but and it was fortunate. I didn't really care. So it's about rocking the boat. Now, don't overemphasize this in an interview, because they might get a little nervous. Like, yeah, I want to rock the boat, you know, make people nervous, but say it in a good way. But you want a culture that allows you to do that. Culture is about what behaviors can condone and what is shunned. A good culture defines what personal risk an individual has to take in order to help manage the risk for the organization. So and Bob Day was a big believer on this. It's individuals making decisions, not committees. That's really key. Now, when I started at USAA, committees made decisions, and I took full advantage of that. If you have a company like that, if you want to rise up in the company, it's so easy. I'll give you a secret. It's really very easy. You're invited to a committee meeting. You don't know why you're invited. You find out what the committee is about. You go do some research. You draft an agenda for the meeting, and you go to the meeting. I had this happen multiple times. You come to a meeting and someone's been assigned to do something and no one wants to do anything. So they all sit there and say, well, what are we going to do? And so I go, well, I drafted an agenda if anyone wants it. And guess what they say? Right. Yeah. And so I pass it out. Suddenly I have control of this project. It's wonderful. You should do it. That's what you want, right? Early in your career, you want control of projects. So you can get experience and learn stuff. You got to work a lot of overtime, but that's just part of the game, right? So I learned that real early. Boy, it was so effective. Just coming to a meeting with an agenda because no one else prepared. It was amazing. A lot of questioning, admission of ignorance. If you can get that kind of company, that's what you want. Procedures are procedures. But one of the things procedure does is it provides that power to the employee to raise issues. So it somewhat reduces that personal risk, because instead of them saying, hey, I think we're doing this wrong, you instead say, hey, we're violating the policy. That makes it much easier on you. A lack of procedures increases personal risk. Organizations need a process for changing procedures. Don't start with your procedures with the regulators and rate agencies, because their goal is risk minimization. Your goal is risk optimization. So you've got to think about it differently. But what you did on paper one is not a bad way to start. If you're working for, let's say you're working for a bank like Silicon Valley Bank. That's your first job. It's 2021. You just started at Silicon Valley Bank. And someone says, hey, we're kind of curious if we just make some changes to our risk management, what would you do? Well, go read JP Morgan. What are they doing? What you did for paper one would be a perfect thing. You'd be pretty confident today, wouldn't you? If you started with Silicon Valley and they say, hey, can you do a review for us? You've got pretty good background to be able to do that. So let me tell you what the big banks are doing. They got an ALCO committee. This is what the ALCO committee does. My risk management class, we talked about balance sheet immunization and duration of net worth. What is ours? You got plenty of weapons that you could have done some pretty good, powerful things at Silicon Valley Bank. And then technology, the purpose of technology is to support risk management. The problem is a lot of times, and that's what I'm worried about USA with 1,000 people, is that they got a lot of people who love technology and they're all out there playing with their technology toys, but no decisions and nothing's actually happening with it. But it's really fun, right? You got this model that runs, a million simulations. You get these beautiful graphs at the end. You learn Tableau, right? So you can make it really pretty looking stuff. But if no decisions made, do any of y'all want a job where you work for 50 years and no decisions ever made off of your job? It would be a pretty horrible career, wouldn't it? So you got to make sure the technology actually has some power, is actually telling you what to do. And that's why I worry with USA that all of their technology is to monitor. They're monitoring. It's like, okay, we're monitoring. You got a risk there. I got a risk there. Risk there. Okay, thank you very much. Next month. Okay, we got a risk there. I got a risk there. Risk there. Okay, that wasn't Bob Davis. Bob Davis was, well, okay, we'll fix that. Next day, was that fixed? No, it wasn't fixed. Okay, well, we're meeting every day until it's fixed. And if it's not fixed in 3 days, I'm meeting with your replacement every day until it's fixed. That was his approach to risk management. You didn't go to him and say, I get this problem. Said, okay, thank you. I'm glad you got the report. No, it's like, okay, we're going to fix it. We're going to fix it right now. So you have to have that. The technologists, they're reporting a bunch of charts and numbers and no one's doing anything with it. It's complete waste of time. Let me show you a firm that had a big risk issue, operational. British Petroleum. They had this major oil spill in 2010. So I was reading an article about it. I was kind of curious, what is management saying? All right, this is, I don't know if y'all don't remember this because you were like in 3rd grade or something, but what did they say? They would say, well, it was a perfect storm of aging infrastructure. That's something management probably should have known about, right? Overzealous cost cutting, risk blindness. Well, that was bad, but at least they know that now, so they'll fix that going forward. They had kind of a going through the form and not really doing risk management. Warning signs, like I talked about, those close calls, they were ignoring those. Too focused on profits. They said it wasn't a problem with culture, it's just kind of things just kind of all lined up all together. So we're really fine. So, and really, if you say, now they should be really good at risk management because they had this horrible thing happen, right? So they've learned from their mistakes. There's only one problem with the article I was reading. That article was written in 2006 about another big crisis they had. It wasn't about this. It sounded like they were talking about that, didn't it? Because everything in that list is what happened when the oil spill happened. But this was written in, I was kind of shocked when I was reading the article because I found it. I had a big bunch of articles, this stack, and I said, should I throw this away? I said, well, this is kind of interesting about British Petroleum. I didn't realize it until the end. I was talking about another event. All right, let's finish up with this because I don't think any of y'all will get this. Who said this in September 2008? It is hard for us, without being flippant, to even see a scenario. We're talking about tele-event within any kind of realm of reason that would see us losing not $1 million, losing $1. He's saying his VAR is less than $1 in any of those transactions. We're sitting on a great balance sheet, a strong investment portfolio, and a global trading platform where we can take advantage of the market in a variety of places. Any guesses on who said that? Who? Not Lehman, but you're in the right category. Not Merrill. No. Huh? No, Bear was February. So AIG. Now this guy, Joseph Casano, you can look him up. This is a very smart guy, very quantitative, he understands these trends. This wasn't a guy who had these guys doing these transactions. He understood them, but he missed the entire thing. So I want to talk more. Thursday, we're going to do something wild. Might get me fired. I don't know. It's kind of crazy. Hopefully I won't step on toes, but I want you to understand the risk of what we're going on with management and people and headline risk and all of that. So last week we talked about, we're getting in this operational risk. A lot of this operational risk relates to planning and strategy and thinking about the future. And I do want to share this particular paper. We're going to get into this a little bit more when we talk about Annie Duke, because I think she has a much more powerful. But planning, first of all, we're not very good planners. This is an article on budgeting for major infrastructure projects. So the British government's budget for the games rose to 9.3 billion from an original estimate of 2.4 billion. You can say, how bad could they be? But if you look at the average, I don't know if I have the average. Organizers of big sporting events tend to overestimate the benefits, underestimate the costs. They are particularly bad on opportunity costs, counting every penny that the tourists are going to spend, but forgetting to subtract the people that are avoiding that area because of the Olympics. I've only been to one Olympics as a spectator, not as participant. I was amazed at how small they are. I mean, the boxing matches, there was no one in the stands. We could do whatever we wanted to. The track events were packed until the Greek athletes left, and then there was no one there. I got to watch the U.S. win first, second, and third in the 400 meter, which is pretty cool. All 7 of us were cheering as loud as we could, but there was just no one in the stands. They don't look like huge money-making events, and yet Athens spent a fortune on new subways and new sporting arenas. Olympic infrastructure tends to break budgets even more than infrastructure projects in general. This particular study said every Olympiad since 1960 is over budget, 180% on average. So how can we be such bad planners? And so, and the Russian Winter Olympics is no different, other than you have a lot of, kind of willing and dealing for Putin's benefit. People are spending a tremendous amount of money. So how do you get around this? Because forecasting is a big part of this risk. And so this is an article by this guy, Sappho, 6 Rules for Effective Forecasting. And I think he has some really good things to say about risk, because if you're a bad forecaster, you're going to be a bad decision maker, and so you're going to be a bad risk manager. So risk really is about decisions and how you make decisions. And if you're making decisions on really faulty data, then you're making bad decisions. Well, Annie Duke will give us even better insights. But common but fundamentally erroneous perceptions that forecasters make predictions. We're going to talk some more about this. What forecasters are actually going to do is give you the distribution. I'm a strong believer in this. The purpose of a forecast is not to predict the future. The purpose of the forecast is to try to estimate the distribution of the future. And that's what you're trying to do. I had this debate at USA. USA had hundreds of people doing forecasting. And we did these point estimate forecasts, and they were horrible forecasts, terrible forecasts. And they're terrible forecasts in the same direction wrong every single time. And if you ask someone at USA, some of y'all heard me ask this before, why do we make forecasts? What would they say, do you think? Why do firms do forecasts? To make what? Make decisions. Try this, give yourself a couple years in your first job, but after the second year, say to make decisions. Well, tell me the last decision you made off of a forecast. And they go, because how it worked at USA is we did a forecast. The CEO looked at it and said, that's wrong. Income should be 10% higher. Went back and made another forecast. He said, that's wrong. Revenue should be 5% higher. Went back and did another forecast. Finally, we figured out, CEO, tell us what the future is going to be. We'll create a forecast that matches that. How many decisions were made off that forecast? Well, none. There was just a bunch of numbers. It was like incredible waste of time and a lot of resources. But I mean, check this, in your first firm, they're going to do forecasts and really look, why are they doing forecasts? How are they using them? Why do they bother spending all that money making forecasts? So I'm going to say the purpose of forecasting is risk management. The full range of possibilities, not a limited set of illusory certainties. So if your firm is doing a forecast, which is a 1-point forecast, one net income, one even over 10 years, I'm going to say it's useless. It's of no value to you. Above all, the forecaster's task is to map uncertainty. I love that phrase. We're in a world where our actions in the present influence the future. Uncertainty is opportunity. For a forecast must have logic to it. The wise consumer of a forecast is not a trusting bystander, but a participant and a critic. Face the task of distinguishing good forecasts from bad. So here's what he says is a good forecast. So all of you are going to be doing forecasting because you're either actuaries or finance people. That's what we do. We do a lot of forecasting. So effective forecast provides essential context that informs your intuition. It broadens your understanding, revealing overlooked possibility and exposing unexamined. That's why I think most forecasts are of no value, because they essentially say what our biases already are. They're just confirming what our biases are. The purpose of forecasts should surprise us. We should find things and say, wow, I didn't see that coming. I didn't expect that. But the forecast also limits your choices. So it should put some constraints on what decisions you can make. So he calls it mapping a cone of uncertainty. Delineate possibilities that extend out from a particular moment or event. The forecaster's job is to find the cone in a manner that helps the decision maker exercise strategic judgment. That's a really important sentence. So the purpose of forecasting is to help decision making, but the purpose is to give the person the full range of what could possibly happen. So you got to figure out its breadth, its uncertainty, and he's actually saying, we're going to see this with Doug Hubbard. He says brutal honesty. So oil prices in 5 years, where are they going to be? Between what and what? Boy, I got too many buttons. So oil prices right now, $75. What's an honest 5-year forecast for oil prices? They got up to 120. They got down to 18. That's in the last 3 years. What if someone says $200 oil? Would you say that's crazy? Does $200 seem crazy? What about $10 oil? Does that seem crazy? Who sitting right here was predicting $18 oil? What do you think their range was? Probably what, 50 to 80? Who's sitting right here was predicting $120 oil? That's like 100% increase in just a matter of like a year and a half. Do you really think sitting right here, you would have, that 120, 125 would have been in your forecast on oil prices? No, it's the volatility, the real world volatility is far wider than our forecast. And you've got to really go out to the extremes. So if I were doing oil, I made a mistake in a media event. They're saying market oil, well, it could be $200. There's no limit. They're like, oh, Ron Sweet's predicting $200 oil. No, that's not what I said. I said, there is no limit to what it can be. We're often surprised. So he's actually arguing to be really honest about how this uncertain you are. So you go out to some pretty wild extremes. Then you might ask, well, what value is that? And that's where we get to Doug Hubbard. So drawing the cone too narrowly is worse than drawing it too broadly. So he says, err on the side of uncertainty. Go out much further. Now, there are statistics that can help you with that. And that's, again, Doug Hubbard's going to help you with that. You can obviously look at the history, look at the volatility of history, do some type of mapping out of that. A broad cone leaves you with a lot of uncertainty, but uncertainty is a friend. The cone can be narrowed with subsequent refinements. Indeed, good forecasting is always an iterative process. And that's something Doug Hubbard talks a lot about. You want that wide uncertainty so that you can identify which piece of data is causing the most uncertainties. So if you're going to spend money, you're going to spend money on refining that one particular piece of information. So if there's anything that really drives the width of this thing, go do more analysis on that so you know where to spend your money. What people actually say in practice is there's no reason to do that because it's too hard to forecast. And this guy and Doug Hubbard says, no, it's actually the hardest stuff to forecast that you should be doing the forecasting on because that's your most important risk number. So they're arguing uncertainty is the thing you should grasp and take to heart because that's where risk management comes in. The most commonly considered outliers are wild cards. These are trends or events that have low probabilities of occurrence, and you simply cannot quantify, but that if events were to occur, would have disproportionately large impact. What do we call this? Black swan. Right, we're going to get to that when we talk about Taleb. These black swans, they don't happen very often. So we tend to assume they'll never happen. And yet we know they're going to happen because we always have big events. The tricky part about wild cards is it is difficult to acknowledge sufficiently outlandish possibilities. Your boss is going to say, $200 oil, are you crazy? I'm not saying I think oil is going to be 200. I'm saying there is a chance oil can be 200. There's a big difference in those two. We need to map that possibility. The essence of what makes forecasting hard is that human nature is hardwired to abhor uncertainty. So our forecasts are far more stable than even the history we've seen. So this isn't a problem of something's going to happen in the future that we've never seen before. It's a really big outlier. No, we're talking about forecast stuff that's narrower than the actual history. We're not even as volatile as the history has. It's not that we're getting shocked by some wild outlier. The result of a Y2K non-event. So y'all don't remember Y2K. What were y'all? Y'all weren't even born then, were you? So if you were born on January 1st, 2000, they're probably saying, yeah, you're done for. The hospital is going to shut down. That was a big event. We spent millions and millions of dollars because we didn't know what would happen when 1999 changed to 2000 and then not much happened. We spent all this money. Does that mean we shouldn't worry about it? But then 9/11 happened. No one was talking about, and yet the Twin Towers had been attacked just a few years earlier. So it's not like it was complete shock. Ask hard questions about whether a seeming wild card, in fact, deserves to be much closer to the center. So, I bring up China and Taiwan. I can never spell Taiwan or something. That's not right. Bill Gates might know. Does that look right? So it just seems like something's going to happen between Taiwan and China, just the way President Xi is talking. Do we really know what that means? Not just for semiconductors. Obviously, semiconductors go in a whole lot of stuff. What does it mean for U.S. military? What does it mean for prices of stuff? What does it mean for Walmart that sources so much of their stuff from China? How is our country going to react? Should companies be running a China attacks Taiwan scenario? And then what would you do with that information? If you're, what can you actually do? Look for the S curve. I don't know if y'all studied S curves, but right now there's a lot of S curves. The biggest ones right now are AI, robotics, EVs, AVs. Those are the ones. Fusion. And what you'll notice by each one of these is we had this big hype a few years ago, and then nothing happened. And then it came back, right? AI is like that, isn't it? AI happened and nothing happened. And then suddenly it's here. I never heard of Chat GPT, and then suddenly it's like, my word, what is this thing? That's crazy. So each one of these is something that we look like it's going to change the world. Nothing happened. We forgot about it, and suddenly it showed up. And that's the typical S curve. You get up and down, and then finally it happens. And so what we do with S curves, we tend to get overly excited about them. And we're talking AVs. By 2020, we're going to all be riding around in AVs, no driver or anything. Here we are, 2020, and it's just not happening. So you have these things. That doesn't mean that we're wrong. It just means that the future is much further out than we're willing to admit. So change starts slowly, incrementally, putters along quietly, and then suddenly explodes. And this is just so true of so many things in the past. Eventually tapering off and even dropping back down. The art of forecasting is to identify an S-curve pattern as it begins to emerge well ahead of the inflection point. And we tend to miscalculate the speed that the inflection point will arrive. There's a tendency to overstate the short term and understate the long term. The left-hand part of the S-curve is much longer than most people imagine. So I like this. Never mistake a clear vision for a short distance. So is AI going to radically change how we live our lives? Sure seems like it. I love the idea of AI planning my next trip. I just say, hey, I want to do this and this and this, and you take care of the whole thing. That'd be pretty cool. Are we getting there now? Who knows? I'm hoping by the time I turn 80, we have autonomous vehicles that I can just, with my eyes that aren't working, I can just walk out, jump in a car that drives me somewhere. I don't have to park. That'd be great. And things like AVs, the reason those things take off all of a sudden is we get comfortable. We start seeing 2 or 3 people or 10 people or 20 people, and then suddenly it just makes a lot of sense and everybody's doing it. It really is, the change is really incredibly rapid. We're linear thinkers. Even if we notice the beginning of a change, we instinctively draw a straight line. So you've got to be, don't be the kind of person that says, well, that was going to happen and it happens, so throw that out. Keep it there, keep it on the table, keep watching it, and keep thinking about it because it may eventually happen. Embrace, this is like the most important thing. Because as a forecaster, we mentioned last class, we tend to invest our egos into our forecasts. And what he is saying is to actually seek out things that contradict your forecast. The best way for forecasters to spot an S-curve is become attuned to things that don't fit what you're thinking. Our dislike for uncertainty, we tend to throw out stuff that contradicts what we're thinking. And you should be seeking those out. When you see something that, wow, that's inconsistent with what I'm forecasting, most of us will just say, that's not important, but we should actually seek that out. I love this. Hold strong opinions weekly. You notice he did not misspell weekly. It's WEA. Hold strong opinions weekly. Our biggest mistake as forecasters can make is to over rely on one piece of seemingly strong information because it happens to reinforce what you already believe. So I mentioned that book on the super forecasters, and this is probably their #1 trait. They're willing to say, this can't be right. I got this wrong. the faster you can say, I got this wrong, the better risk manager you're going to be. So in forecasting, lots of interlocking weak information is vastly more trustworthy than one strong piece of information. Once researchers have gone through the long process of developing a hypothesis, they tend to not want to change it. Good forecasting is the reverse. It's a process of strong opinions, weakly held. If you must forecast, forecast often and then throw out the ones. Now, Taylor's going to say the same thing, although he says forecasting is fine. Like if you're forecasting whether it's going to rain or not next week for a picnic, that's fine because that's not going to destroy the world. But if you're Silicon Valley Bank and you're making a forecast and you don't know what you're doing, then you're destroying a lot of people's lives. And so he's going to talk a lot about the problem with forecasting as well. Having strong opinions gives you the capacity to reach conclusions quickly, but holding them weakly allows you to discard and move on. He says, go back further in time. I'm not so sure how well that works as much as the world is changing so rapidly. And this is one area where I worry about AI. Now, I don't know how AI competes with AI. That's going to be interesting because AI is looking at data to find human biases and mistakes. But eventually AI is going to be looking for robot mistakes, AI mistakes, and I don't know if it's who wins that battle. It's going to be fun, right, to watch. I'm going to be watching it from the nursing home. You guys are going to be in a job dealing with it. So it's going to be fun to watch. What worries me the most about AI is how black box it is. It's going to be doing stuff that's going to get so sophisticated, even the person who created it are not going to be really, really sure what the thing's even doing anymore. It's just giving information. I thought it was interesting. The Economist was talking about AI. Wasn't AI, I think it was ChatGPT had written something and he wanted to get it published and have the AI be the publisher, and he lost that case. It's like, no, you have to be a human being. Now I've seen a case where I think it was a gorilla or something took a picture and it was a really good picture, and the guy, he got it published and he got sued by some animal rights that's saying you didn't take the picture, the gorilla took the picture, he should get all the money from it. That's kind of a strange case, but here we're saying non-humans, even non-animals, can have a legal right to something. What that even means, who knows? So I don't know. AI to me kind of it's such a world-changing event that we'll see. We're in a moment when old mass media order is being replaced by new personal media order. The cutting edge players of the information revolution are peddling every bit as hard. The recent past is rarely reliable. So he's actually saying the fast change makes the recent past unreliable, but the longer term past is more reliable. So you may not agree with that argument. That's of his arguments, just the one that it's hardest for me to try to get. I do like this last quote though. The temptation is to use history, as the old analogy goes, the way a drunk uses a lamppost for support rather than an illumination. So if you're going to use history, use it for insights. Don't extrapolate, but we do extrapolate history a lot, and that's rarely the right thing to do in this time. And then know when not to forecast. Now here's where he's going to disagree with Doug Hubbard. Hubbard says you always put down what you know on paper. So Hubbard's big thing is people say you can't do it because it's just too uncertain. He says no, that's when you most need to do it. So Hubbard's big thing is we forecast the easy stuff because we have data. We don't forecast the hard stuff, which is where we need to be spending our time because that's where we go insolvent. So we throw things out just because we don't feel comfortable with the numbers. What do you do when the uncertainty is so great? So China, Taiwan might be one of those. What should Exxon do now, thinking that China might attack Taiwan? They probably have some pretty smart people that can walk through that. Are there things they should actually do now, today, though, in anticipation of that? Now, I spoke to the risk managers at UTSA a few years ago, and I was talking about AVs. Autonomous vehicles could destroy UTSA because cars are probably 60–70% of their revenues. And so they're asking me, well, what would you do if you were at UTSA? I said, well, if I were UTSA, I'd probably create a department couple of actuaries, a finance person to figure out how to insure AVs. And I would call Uber and Lyft and try to be the first person in line to figure out what they need. I would spend a little bit of money. Let's create a product that's ready for AVs so we can be the first ones out there. That's maybe what I would do. Doesn't cost you that much money, but I doubt they're going to do that. But they got 1,000 people in risk management. They can certainly put three aside to create a new product. They certainly have the people to do it. They have the actuaries to be able to do that kind of product. Someone might say, well, that's not USAA. They're a personal lines writer. They're not a commercial writer. But hey, if your customers don't own cars anymore, you're going to have to do something. Your bank's not going to do auto loans anymore. You're not going to sell any more auto insurance. Are you just going to shut this business down or what? I was listening to one podcast about Kodak, and people were saying, Kodak, you should have responded. You should have gotten into the digital age and all that. And their response was no, because Kodak had no expertise. And essentially, the argument of Kodak is they're done for. I mean, you can think, have y'all done a Kodak case in any of your classes? And this was the conclusion: was Kodak's business model, they had nothing they could do to save themselves. They were done for. Because the places they need to move to, they had so little, there's firms out there that were so far ahead of them. Their expertise was film. When's the last time you bought film? Have any of y'all never bought film in your life? Is that true for any of y'all? You never bought film in your life? Have you ever had your picture taken with a film camera? Probably when you were 2 years old or so. Yeah. Can you really? Oh, Trent, yeah. Yeah, on long playing records, or I got a bunch of those. I should sell them because I don't ever listen to those. Yeah, but that's the, and maybe that is the answer. Now you take Blockbuster. Blockbuster's a little different. It still amazes me that Netflix called the company Netflix, because there was no streaming when they started their company. That's pretty astute, isn't it? You got a firm that calls themselves Netflix when they're smelling disc and CDs or disc, actual tapes. So obviously their CEO had a vision out there. You would think Blockbuster would have heard that and kind of said, that's kind of interesting. Could Blockbuster have survived? Are there companies that are simply going to go out of business and there is nothing they can do? So I don't know. There's maybe it's not worth going to the extreme because you just don't survive. Well, Valero survived the electronic vehicle. I was talking to a Valero employee, and they're doing this, driving around picking up restaurant grease. So that's interesting. That's good. That's kind of biodegradable, but that doesn't sound like that can even become 1% of your business. I mean, it seems like a really small thing, but they said they got a whole department working on that. But does Valero exist in 20 years? And is there anything they can do today to handle that? We've been talking about electronic vehicles for some time. They're certainly growing in popularity. California has a rule that, it's interesting. Valero has refinery plants in California, in a state that's going to make gas cars illegal. If you're a CEO of Valero, what would you be doing today? You're going to do liquefied natural gas. You're going to be doing French fry grease. What are you going to do? Or you're just going to say, hey, we're going to still have oil and gasoline 50 years from now. This global warming thing is not going to happen. It's tough. Do you think they're talking about that? Certainly they are. Hopefully they are. Thus, moments of unprecedented uncertainty when the cone broadens to a point at which the wise forecaster would demur and refrain from making a forecast at all. So we'll see what Doug Hubbard says on that. He might get a little disagreement on that. Don't take any forecast too seriously. Now, this next one, I won't go through this one, but I like this. You see the first writer there, Nobel Prize winner there, Daniel Kahneman. Again, it's about decision making. We're going to talk, because decision making is the most important risk management thing that we do. So Kahneman says, well, first of all, we're going to see him later. We're going to talk about him. His big thing is bias. We have these biases. They cause us to make bad decisions, bad statistics. He gives a bunch of them. We'll talk about his actual confirmation anchoring. So what he does, he and Daniel Tversky, what they did is they went out and tested these economic theories with live people and discovered that people don't react the way rational economics says they would. That we have biases, they're predictable biases. We all have them. And the amazing thing is this last sentence: awareness of the effect of biases has done little to improve quality of business decisions at either individual or organizational level. He's saying even when we're aware of our biases, we don't overcome them. They own us. So the purpose of this article is there a way we can make better decisions even though we know our bias is going to mess us up even when we're aware of them? And that's what he's talking about here. And the way he breaks it up, I found it fairly fascinating. He has these lists questions. You got this article out there so you can read it. So he says there's 3 levels of questions you should ask, you as the leader that's making the decision. So you start off with questions that you should ask yourselves about your own biases. Has the team fallen in love with this proposal? You know, it's this kind of thing where you'll see this a lot. The team, for some reason, has kind of already gone into the project with a strong bias that they like it. Groupthink, pretty common. I can tell you how Bob Davis handled groupthink. I thought it was pretty ingenious. You might try this. But he's about to get a decision. It's pretty obvious he's got the decision. I'm going like, vote now. I'm thinking vote now because I'm ready to go. He doesn't do that. He goes around the table. He goes, Wendy, what do you think? Mark, what do you think? And guess what suddenly happens? Oh, you know, I'm not so sure now. And then I have to go, all right, I'll go back to your office and present the whole thing to you again. And, you know, it's just irritating for me, but there were 4 or 5 people in the room who weren't ready for the decision. And he went around one by one. It was really, really powerful. So that's a good way to do groupthink, is, you know, kind of put people on the point and have them each speak. Sometimes you can have one person that's just like dominating the group, and you got to kind of get away from that person. Where are there dissenting opinions within the team that just aren't being heard because there's some loud person that's dominating? All right, where's the second set? Questions that decision makers should ask the team. Could the diagnosis be overly influenced by the analogy of a memorable success? I've done that a few times. You do something and it works. You're like, yeah, man, I'm a king. I understand this. And that same thing comes up again. Hey, got it. Yeah, let's do it. And the next time it's just a flop. Like, well, that can't be right because that implies the first time could have been lucky. And obviously I was a brilliant genius the first time. Check for confirmation biases, which is a huge issue for us. More critical alternatives included along with the recommendation. I tell my business finance class, the first big project I got was the CFO saying, Ron, our healthcare line is a disaster. We need to shut it down. Can you do analysis that shows why we should shut it down? Was there any bias in that question at all? And so I did the analysis, and the healthcare line is actually far more profitable than he realizes because of the allocation effects. So I had to come back to him sheetlessly and say, yeah, I disagree with you. It's actually a pretty decent line of business. But at that point, he didn't care anymore. He forgot he had asked me to do the project, but still, I took it seriously. Check for availability biases. If you had to make a decision again in a year's time, what information would you want? And can you get more of it now? Use checklists. Check for anchoring biases. Do you know where the numbers come from? Are there unsubstantiated numbers? Too much extrapolation from history. Check for the halo effect. You have some person in there that's dominating. Check for the sunk call. It gives you some of these fallacies. And then the last group of questions on evaluating the proposal. And he gives you a pretty good list here of things you can do. And his argument is you're hopeless to overcome your biases as an individual. But if you can create a community, and Annie Duke's going to really get into that. How can you use a team approach? It's something we tried at USA, and it's extremely effective. We have something called the asset group or something. And we got together every week, and you would have thought we hated each other's guts. It was just a free for all. And I'll talk about that. It's very similar to what Annie Duke's talking about. But we're all very confident because we've been in our careers for some time. We're all wealthy enough that, you know, we didn't really care. Ours, we don't care. And it was just a free for all. But at the end of it, we knew we had thought about everything we possibly think about because we're just like challenging each other. So he's saying it is possible. Not, you can't be perfect, but you can do much better when you bring the community aspect to it. So I encourage you, read some of these articles. You're saying I'm finance, I'm not strategy. Risk management is all about decision making. You're making decisions. You need to focus a lot of your attention on your career development on how to make better decisions. That's why I throw out Kahneman and Tversky and Hubbard. It really is about good decision making. So where we're going to go from here is we're going to finish up those last few risks. I got to do those. But once we finish those, then we're going to really get into some of these great thinkers and see what they have to say and see if there's some gems you can pull to make your career much stronger. All right, I'll stop it there. Make sure you have your own attendance if you came in late.